and closed nearly flat at 19,118.99, retracing gains seen in early trade, while the Topix index added 1.32 points. Across the Korean Strait, the Kospi closed up 6.12 points. In Hong Kong, the Hang Seng index was down 0.74% in afternoon trade. Chinese mainland markets ended in positive territory, with the Shanghai Composite up 13.99 points and the Shenzhen Composite adding 12.54 points. Australia's ASX 200 fell 11.96 points, with most sectors finishing down. Of course, here in Nigeria, the gross domestic product contracted by 1.30% in the fourth quarter of 2016. That's according to the National Bureau of Statistics in its fourth quarter 2016 and full year 2016 GDP report released today. The NBS says the decline is less severe than the figure recorded in the previous quarter of minus 2.24%, but is lower than the growth rate recorded in the final quarter of 2015. For the full year 2016, the GDP contracted by minus 1.51%, indicating real GDP of 67.98 trillion naira for the year. According to the Statistics Office, this reflects a difficult year for Nigeria, caused by weaker inflation, an increase in pipeline vandalism, weaker currency, among other issues. Nominal GDP stood at 29.29 billion naira at basic prices in the fourth quarter of 2016. Meanwhile, analysts have been reacting to the latest GDP figures released by the Statistics Office. A group of panelists at the channel's LCCI Business Roundtable believe Nigeria needs 2 consecutive quarters of positive growth to get out of recession, as well as an improved agriculture and manufacturing sectors to boost the country's economy.
In reality, you need 2 quarters of positive growth to actually come out of a recession. And we had already started predicting that we are actually going to see a slower dip on the recession and a growth, which is coming back to the reality that everybody is actually saying, or actually looking at a last quarter recession to a first quarter 2018 growth year, where we can actually say we're coming out of recession. And you can actually see it also in the positive lights. Figures coming out actually by September, August, we're already doing over 1.2, 1.3 million barrels a month a day. In
terms of oil
production. And that itself has seemed positive, because all of us actually saw that by December, which is the last quarter of the year and the last month of the year, we were going to expect that the central bank would see a better position, because we're actually seeing positives on the actual oil, and that itself in turning positive on the actual economy.
The fact that agriculture and agro-allied is being relegated and is not being given the pride of place has impacted on the GDP somehow, in the sense that for the country to go out of recession, you must be a producing country, intensively producing country. And the role of agric and agro-allied at this point cannot be overemphasized. In terms of social and economic framework of the country, production has to be given enormous priority. And how do I mean? If you look at all the most prosperous countries of the world, you discover that they focus a lot on agriculture. Right now, as I'm talking to you, the world has reached 7.5 billion in population. And you discover that about 6 countries are actually covered half of them. And those are the United States, China, India, Brazil, Indonesia, and Pakistan. All of these countries I just mentioned, they have a very robust and sophisticated economy predicated on agriculture. So in Nigeria, if we're really going to get out of the woods, then we have to pay a lot of attention to that.
In the last quarter of last year, you know that foreign exchange was not very much available. And in the maritime sector, the forex is a common denominator. So importers didn't have sufficient access to foreign exchange, despite the special window created for them. You saw the spiraling rate of the naira to the dollar. Based on that, there was a drastic 70 to 80% reduction in cargo throughput. The volume of cargo imported into the country dropped. Many shipping companies left Nigeria. The largest shipping line, Maersk, sacked 400 people. Many terminals closed. The ports were so empty that the security men used chalk to draw football fields and play football because the place is empty. So if the raw materials are not coming in and the manufacturers are not manufacturing, of course, that's your production drops. So we expected it was. And worse still, with the restiveness in the Niger Delta spiraling, gas pipelines being broken, there were no guaranteed gas supplies to power electricity for manufacturing. So we found the whole supply chain was affected. When the shipping lines are closing down, they're not getting cargo. They drop their freight rates to almost uncompetitive rates. The terminals are empty. The custom license agents have little business to do. The transporters have their trucks idle. So the entire trade is affected. So the MPS is right to show us the grim reality that the GDP is seriously impacted.
And in Uganda, the economy will grow 5.5% in the year to June 2018, edging up from estimates for the current fiscal year, thanks to lower borrowing costs and higher oil sector investment. The East African country's central bank began a round of policy easing last April. Since then, the benchmark rate CBR has dropped from 16% to 11.5%. Issuance of crude production licenses would boost activity in the oil sector and also aid growth. Uganda discovered crude reserves the government now estimates at 6.5 billion barrels about a decade ago in its western region along the border with the Democratic Republic of Congo. And Botswana's central bank expects the economy to expand by more than 4% annually in the next 2 years, following growth below 1% in 2016. The landlocked Southern African nation, which has kept benchmark lending rate at 5.5% at its last two meetings, has struggled with weaker growth in recent times as mineral sales slowed and electricity shortages hurt mining. Well, we'll take a quick break now, and when we return, we'll look at, of course, the implications of the latest GDP figure on the domestic market. Do stay with us.